Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates and 10-year note yields still hovering at that 3-month midpoint of the range. Now, remember, we did see the range move up. It was 230 to 240, and we saw most settlements, most weekly settlements, at around 235. Now we're seeing the range extended to 230 to 250, but we're hovering just above 240. So we're still at the midpoint of the range. We're just, it's a little bit higher. But ultimately, the market is still kind of looking for that breakout move. We thought we might have had it when we traded up to 2.5% yield, but we didn't. The market reverted back. So right now, still in the middle of that range, still waiting. And as you can expect, volatility is going out on the year-to-date lows. This has been not a great year if you're a buyer of volatility. Volatility has trended lower pretty much all year. It's been one of those years where you would have expected maybe with the Trump presidency, with the Federal Reserve getting more aggressive, there could have been some kind of a breakout move, but volatility obviously trending lower as the market remains in a pretty good range. So right now, range-bound trade, low volatility, that is really the theme for 2017. And if you look at what we've seen in the 10-year per se as a range, we've traded about 62 basis points of range in yield. That's the lowest I've going back as far as I can look, and it averages around 150 basis points over the last 10 years. So that is a pretty narrow range. Likewise, volatility is going on in its lowest in the last decade. So we're seeing low volatility, narrower ranges. Despite the fact that the Fed is trying to get out of the way, they are still heavily involved in the capital markets, in the bond market, and that is really what's happening here. Is we're seeing narrow ranges and lower volatility. Now, until that changes, and when does that change? Well, obviously, there could be a lot of reasons why that changes, whether it's geopolitical, whether it's economical, whether there's something on the horizon out there that we don't see. Inflation could make a turn higher or lower. We could see the yield curve continue to flatten, maybe possibly invert. So there's a lot of things out there that could change this. But for right in here, right now, as we end 2017, we are seeing the curve go out as flat as it has, as low volatility as it has, and as narrow a range as we've seen in the outrights in a long, long time. So hopefully we see something blossom in 2018. Maybe it comes from the Fed, maybe it comes from the economy, maybe it comes from Washington. Hopefully a little bit of each will contribute to something that moves this market, because with equities on all-time high, we're seeing commodities break out, gold and oil to recent high prices, and still no volatility in the bond market. So something needs to change. The bond market is waiting. It's in sort of wait-and-see mode, but hopefully that all changes in 2018. This is Todd Colvin coming to you for the last time in 2017 from the floor of the CME Group.